Hey there, Bobby here from Payitoff. I just want to show you a quick demo of our new functionality we released today related to in-progress income-driven repayment plans. So basically this means if you have a client that comes to you and says, I'm halfway through my pay-as-you-earn repayment plan or I'm partially through PSLF, how do you evaluate the rest of that loan term? As well as how do we look at the trade-offs for refinancing or other federal forgiveness programs? So now you'll be able to get to these trade-offs a lot sooner using this software. So let's look at an example. We have Harry. Harry has a mixture of subsidized and unsubsidized direct loans and a private loan from Wells Fargo. And there's new information that we're using to estimate exactly what the remainder of these loan terms looks like. So we need to know the months in repayment, the balance entering repayment, and what their current repayment plan is. The loan sync should give us all this information, but in case it doesn't, you can edit it here, where you're able to look at both income-based plans, repay or pay, and of course standard and extended, which we already support. What's really cool though is that you can say, all right, now I want to look at if we refinanced these loans, even one of the ones that's in the income driven plan. Let's look at what an extra monthly payment would do, as well as looking at other federal programs. All right, so let's give it a whirl. Okay, so what we see here is exactly what the remainder of the term is for the current status of their income-driven repayment option, what the total cost is as well, including any taxes paid at forgiveness events. Speaking of forgiveness events, you can notice here in the balance over time that there's a drop-off. And one of the loans that we had entered, or one of the loans that had synced, was a loan that had about halfway through the pay as you earn program. And here it is being forgiven. And we can see how that balance changes over time. We can also see what prepayment and refinancing can do if we were to refi those first two loans and the interest savings there. Now let's look at the prepayment schedule here before we get into refinancing. I want to call out that we only prepay standard or extended loans. We're not prepaying on IDR yet, usually because it doesn't make any financial sense to do so. So the timeline will reflect the normal schedule for these loans. So you can actually see this forgiveness event in April of 2030, the one that you're seeing in the graph earlier. One thing to consider though with refinancing is that the monthly payment goes up quite a bit. So we're around $900 on a monthly payment, which in a lot of cases might not be great. So in this case right here, if we look at the refi timeline, we can see the two loans getting refinanced and applying the extra payment to that, exactly when that gets paid off, and then when that other loan gets paid off as well. And on that forgiveness event, we'll see what the balance is at that moment in time. Okay, so let's keep going here. Let's look at these other income-driven repayment options. So we're in the pay-as-you-earn plan. So if you want to see exactly what the rest of the schedule for their current plan looks like, this is the screen you want to be on. You just click on their current plan. You can go down and see year by year exactly how much interest is subsidized, capitalized, exactly how much they pay, all the way down till it's forgiven. So this is pretty powerful. I mean, right now you're able to see how much it actually costs them, and then on top of that, what the forgiven debt is estimated to be when it comes to the tax bill. And we're accounting for every forgiveness event throughout that timeline. You can also look at the revised pay-as-you-earn plan. So we have a pretty similar monthly payment on those plans, but it turns out we're paying a little more on repay because repay doesn't have a cap on your monthly payment, and it doesn't have a cap on the capitalization that can occur. So we end up paying a little more on repay, but our forgiven amount is a little bit lower because of the very generous subsidizing behavior. So it's interesting to look at this because then you can say, oh, the tax bomb is lower for repay. The timeline is the same. Does it make sense to switch over? Well, when you switch plans, capitalizing, interest does capitalize. So you have to evaluate that. The next module we'll be building will be showing you, hey, if you were to leave a plan, what is that? What is the risk of doing so? So we're going to make that even more transparent than we already do. And you can look at IBR, but in this case, it looks like you're spending a lot more over the life of that particular repayment option. So let's look at one more example, and then I'll let you go. So Harry, if we're looking at Harry's situation and saying, hey, Harry, you might be able to, or in fact, you actually, all those payments you were making qualify for PSLF. Let's look at how that affects your outcome. And we go back to Harry over here. Okay, let's look at what the difference is if we're in PSLF. Oh boy. So refinancing actually doesn't make any sense in that particular use case. We have a negative interest savings, meaning that we're spending way too much money. It actually makes more sense to lean on forgiveness and not to go towards refinancing in this case. So if we look down, we'll see why that is. Well, it's because the maximum term on these is only 9 years and 7 months because of the PSLF option. So that's a really interesting and powerful message to be able to talk through. They only spend $21,000 on the rest of this term using PSLF, and they don't have any taxes to pay when the forgiveness events occur. So this is pretty powerful stuff, and you'll actually see some of these loans, drop off. Right here, you can see the balance going down, so a forgiveness event has occurred at that point in time. And since the repayment term is 120 periods for that, and we're 100 periods in, that 20 months makes sense. So it's important to I know there's a lot of information in here, but it's important to go back and forth and sort of look at each of these numbers and say, okay, why is this, why does this number look this way? Okay, well, let's dig deep and look into the details here. How much interest is being subsidized? How much is capitalized? And you get a really good sense as you go along of exactly how this stuff builds up in a timeline fashion. So we hope that this is very helpful when you are working with people who are currently in plans, because I know there's usually a lot of question marks when you're unsure about exactly how much it's going to cost them to stay in their current schedule. I hope you enjoyed this demo, and thanks so much for watching.